Welcome to the Deep Dive. Today we're tackling financial shenanigans, those tricky maneuvers companies sometimes use.
Right. Ways they make their financial performance look, well, better than it really is.
Think of it as sort of decoding the signals,
Mm,
to see a company's true health.
exactly. And our guide for this exploration is the book Financial Shenanigans: How to Detect Accounting Gimmicks and Fraud in Financial Reports. We're drawing on insights from the fourth edition.
That's by Howard M. Shillett, Jeremy Perler, and Yoni Engelhardt, experts who've spent decades uncovering these practices.
They really have. It's amazing how far back their experience goes. Shillett started researching SEC documents on accounting frauds way back in the early 90s.
Wow, that's some serious foundational work.
Yeah.
So for you listening, this isn't just theory. It's like built on years of real-world analysis.
Absolutely. They've essentially dedicated their careers to spotting these recurring patterns, and the book itself points out, the first edition in 93, it confirmed a real need.
People wanted this information.
Yeah, investors, both individual and institutional, they were looking for practical ways to, well, protect their investments.
Which makes total sense. I mean, if you're putting your hard-earned money into a company, you want the real picture. Like,
Definitely.
the book clearly resonated. I read they even ended up training analysts at major investment firms.
It speaks volumes about its real-world value, doesn't it?
It really does.
It just highlights the practical side. And unfortunately, over time, the lessons in financial shenanigans, they've only become more critical.
You mean like with the big scandals?
Exactly.
Yeah.
The early 2000s brought Enron, WorldCom, Tyco, and the second edition of the book saw this massive jump in interest. Investors got, understandably, much more cautious.
It's almost like an essential toolkit for navigating the whole investment landscape.
Mhm.
In the newest edition, it's expanded to cover a key area, hasn't it? Something about acquisitions.
Yes. Acquisition accounting shenanigans. They recognize that M&A, mergers and acquisitions, have become a really common backdrop for these accounting games.
Because they're so complex.
Right. The inherent complexity can create opportunities to sort of obscure a company's true financial state. So for you listening, understanding this is crucial when a company you're invested in starts buying up other companies.
Okay, so the book breaks down these different kinds of shenanigans. Let's get into some specifics. Maybe start with how companies might manipulate their reported earnings. That's part 2 of the book.
It is. They categorize earnings manipulation into 7 broad types. We probably won't hit every single one today, but let's delve into some of the most common, the most illustrative examples. The first one they highlight is recording revenue too soon.
Okay, sounds simple enough, but I'm guessing the execution can be pretty deceptive.
Oh, definitely.
What's a core principle? Like, what should you, as an investor, always keep in mind about revenue recognition?
Well, the fundamental principle is that revenue should only be recorded when it's truly earned and realized, or at least reasonably assured.
So the job's done, basically.
Right. Typically, the product's delivered or the service performed, and you're pretty confident you'll get paid. Recording it early, that just artificially inflates current earnings, often at the expense of future periods.
So if a company's showing amazing growth, you gotta ask.
Is this revenue real and earned now? Exactly.
Can you give us a concrete example?
Oh.
A company that got caught recording revenue too early.
Oh, a classic one is Computer Associates, CA. They were notorious for literally stretching their accounting months, sometimes to 35 days.
45 days. Seriously.
Seriously, just to shoehorn in more sales after the normal month-end cutoff. It's a pretty blatant manipulation.
And did they get away with it?
Not in the long run. That practice ultimately led to the CEO's imprisonment. So for you, this highlights why you should look for weird reporting period lengths or, inconsistencies compared to others in their industry.
Wow, 35-day months. That's bold. What about maybe less obvious ways companies jump the gun?
MicroStrategy, back in the late 90s, is another big example. They had to issue massive restatements of their financials for several years.
These statements are always bad news.
Always. It turned reported profits into substantial losses. And predictably, their stock price just collapsed.
Ouch.
So a key insight here for you is when a company restates, especially for revenue recognition issues, that's a major red flag. It means you couldn't rely on those prior reports.
A painful lesson. I think I remember reading about a weird boomerang payment scheme MicroStrategy used. What was that about?
Right. In one deal with a company called Exchange Applications, Exchange paid MicroStrategy partly in cash, partly in stock. But Exchange also became a master affiliate for a MicroStrategy venture.
Ah, so it looks like revenue coming in, but
Yeah.
it's kind of circular.
Exactly. Unsustainable. It wasn't genuine end-user demand driving things. For you, this shows why you need to look beyond the headlines and understand the substance of the deals. Are they really arm's length, driven by real customer needs?
So not just organic sales growth from their actual products,
Precisely. Another angle is when companies change their accounting policies for revenue recognition. Sometimes it's to hide underlying weaknesses.
like changing the rules mid-game.
Kind of. Olvac in 2010 shifted to percentage of completion, or POC, accounting. Now, POC can be legit for certain long-term projects.
But not always.
Well, in Oldac's case, it let them recognize revenue much earlier than their old method. It made their declining performance look like it was improving.
Sneaky.
So if you see a company changing key accounting policies, you absolutely need to understand why and what the impact is on their reported results.
Okay, that makes sense.
Yeah.
What about situations when the buyer hasn't fully, accepted the product yet? Seems like another risky area.
It absolutely is. Generally, you shouldn't record revenue until the buyer gives final acceptance. The book points to a few examples here. Krispy Kreme, for instance.
The donut place?
Yeah. Allegedly, they recorded revenue as soon as the product shipped, even if it wasn't shipped to the actual customer.
Wait, how does that even work?
Hard to argue a sale is complete if the intended buyer doesn't even have the goods, right? For you, this highlights looking for mismatches between sales and actual delivery or customer acceptance.
Sounds like sloppy logistics, but maybe deliberate. And what about shipping the wrong stuff entirely?
Exactly. Symbol Technologies and Informix were cited for shipping incorrect or incomplete products, but still booking the revenue.
Hoping they wouldn't notice or return it.
Or maybe just kicking the can down the road. The point is, the sale wasn't really final. The revenue shouldn't have been recognized yet. It shows you need to consider not just if something shipped, but if the right thing shipped and if the customer truly accepted it.
So the revenue recognition was basically hanging on future events that might not even happen.
Correct. And then you have situations where companies may be under pressure, loosen their standards for customers who might not even be able to pay.
Like recognizing revenue from someone likely to default.
Pretty much. OpenWave, for example, had a policy change allowing them to recognize revenue from customers previously deemed deadbeats just by, well, subjectively deciding they weren't deadbeats anymore.
Wow, that's just wishful thinking as accounting.
It can be easily manipulated. So as an investor, be wary of companies with overly optimistic or changing views of customer creditworthiness, especially if it causes a sudden revenue jump.
Okay. And what about those really generous payment terms some companies offer?
Right. Seller-provided financing and extended payment terms, they can also be significant red flags.
It's not always a shenanigan, though, right?
Not always, no. But it can be used to pull revenue into the current period by tempting customers to buy earlier than they normally would. The worry is whether these sales are truly solid or if it just steals from future revenue.
Creates a hole later on.
Exactly. Telecom equipment suppliers during the dot-com bubble and more recently, companies like Trex and Fitbit face scrutiny here.
Fitbit. I remember their stock struggle.
Yeah, in Fitbit's case, extending payment terms in the Asia-Pacific region actually foreshadowed deeper business problems that eventually tanked their stock. For you, extended payment terms, especially with rapid revenue growth, should prompt a deeper look into the quality and sustainability of those sales.
It's like pulling future sales into today. Looks good now, but it's not sustainable. The book even mentioned some really weird examples like using insurance policies.
Oh yeah, the Brightpoint and AIG case was unusual. They set up a retroactive insurance policy to cover Brightpoint's past unreported losses.
Retroactive insurance. How does that work?
It doesn't really in terms of actual risk transfer. Brightpoint paid premiums, AIG paid out an insurance recovery that conveniently matched the losses that had already happened.
So no real insurance, just moving money around.
Essentially a disguised financing deal. But Brightpoint recorded the recovery as income, and AIG booked bogus revenue from the premiums.
That's wild.
It highlights why you need to be skeptical of transactions that seem overly complex or just lack a clear business purpose.
Completely artificial. Okay, so that's recording revenue too soon. What's the next major category of earnings manipulation?
That would be recording bogus revenue. This goes beyond just timing issues. This is recording sales that, well, never actually happened or lacked real economic substance.
Okay, now we're talking outright fabrication.
Pretty much. So, For you as an investor, this is where things get particularly concerning.
How do companies actually create phantom sales?
One way is using non-binding contracts to create fake receivables on the balance sheet. Peregrine Systems was a prime example.
Peregrine again. They seem to pop up a lot.
They're kind of a poster child for shenanigans, unfortunately. They booked huge revenue based on agreements that weren't legally binding. This led to a rapidly growing accounts receivable balance that ultimately would never be collected.
So the warning sign is?
A sharp rise in accounts receivable that outpaces sales growth, especially combined with weak cash flow. That can be a critical warning sign of potentially bogus revenue.
And didn't they try to cover that up with cash flow tricks too?
Exactly. We'll get to those cash flow manipulations later. They often go hand in hand.
Okay, what other techniques?
Outright fake transactions. Symbol Technologies, again, they conspired with a South American distributor. Created over $16 million in fictitious revenue.
Yeah.
They told the distributor to submit purchase orders for stuff they didn't need. Symbol then shipped the goods to their own warehouse to fool the auditors,
Whoa.
all while keeping ownership and risk. The distributor never had to pay. For you, this emphasizes scrutinizing unusual sales patterns, especially large deals with little apparent business reason.
That's incredibly brazen. What about barter deals? The book flags those too, right?
Yes, barter transactions, especially involving related parties, should always raise suspicion.
Because no cash changes hands.
Right. Companies exchange goods or services, and the recorded sales amount is based on their own valuation of what they got, which can be easily inflated.
ComScore had big issues with this.
What do they do? Significant exchanges of data assets with other providers, many of whom were related parties. These non-cash deals made up a huge chunk of their reported growth. Questions about their legitimacy ultimately got them delisted from NASDAQ.
So the lesson is?
Be very cautious with companies reporting lots of revenue from barter, especially with related parties. Try to understand the true economic value.
It's like saying, I'll give you this thing that's hard to value, you give me that thing that's hard to value, and we'll both call it a big sale.
Pretty much. And the risk goes way up with related parties because the whole arm's length transaction idea is questionable. Syntax Brilliant also had this complex web with the distributor, S-Surety.
Related party.
Yes, and Suyuri accounted for nearly half their total revenue. Plus, the payment terms were incredibly lenient, suggesting the sales might not have been genuine.
So big flags are a significant revenue concentration with related parties and weirdly generous payment terms.
Absolutely. Warrants careful examination.
Okay. What about improperly classifying the sale of assets as revenue? That sounds weird.
It is counterintuitive. Normally, selling an asset, any gain or loss goes separately, not in operating revenue. But Iconics, for example, would carve up its trademark assets by region, sell some off, and record the entire proceeds as revenue.
Not just the profit, the whole amount.
The whole amount? Sometimes they even created the customers through joint ventures to book these sales seemingly out of thin air.
So you need to check if revenues from core operations are just selling off parts of the business.
Exactly. Are they boosting the top line by selling assets? That's not the same as generating ongoing revenue.
Got it.
The book also highlights unusual deal structures. Intel and Marvell had a deal. Marvell bought some assets from Intel, but also agreed to buy wafers from Intel at inflated prices for the next 2 years.
Why?
The suspicion. Marvell underpaid for the business up front, and Intel got the cash back, later disguised as inflated revenue from wafer sales. Made Intel's ongoing revenue look stronger than a one-time asset sale.
So it manages the perception of the income type, making it look recurring.
Precisely. Recurring revenue looks better to investors, suggests stability. And then there's shifting a struggling division's results to discontinued operations right before selling it.
Hiding the loser.
Basically.
Yeah.
Sabre Corporation did this with Travelocity before selling it to Expedia. By moving Travelocity's losses out of continuing operations, Sabre made its core business look more profitable.
Did they fudge the numbers too?
Astute investors might have noticed Sabre even increased the historical cost allocation to Travelocity after marking it discontinued, further boosting the remaining segment's profits.
Wow.
So for you, when a company sells a segment, scrutinize both continuing and discontinued ops to see the real profitability of what's left.
It's like hiding your less successful kid for the family photo. Okay, covered revenue too soon. Bogus revenue. What's the third earnings manipulation category?
That's boosting income, using one-time or unsustainable activities. Using events or transactions outside normal operations to artificially pump up reported profits for a period?
So making the income statement look good short term, even if it doesn't reflect the real ongoing business.
Exactly. For you, the key is spotting the difference between sustainable earnings and these temporary non-recurring boosts.
Give me an example.
Selectively reporting gains from unconsolidated investments while hiding the losses. Enron was, well, notorious for this.
Of course, and wrong.
They'd trumpet big gains from partnerships, but often fail to report substantial losses on those same investments, claiming they were unconsolidated. As I win, tails I still win.
Totally misleading.
So for you, always look for the full, consistent picture of investment performance gains and losses.
What other unsustainable tricks boost earnings temporarily?
Improperly capitalizing normal operating expenses, big one. Instead of expensing costs when incurred, they treat them as assets on the balance sheet.
Delaying the hit to profits.
Exactly. Makes current profits look higher. WorldCom famously did this with billions in line costs their biggest operating expense, capitalizing them grossly understated expenses and overstated profits.
So you should watch the relationship between expenses and revenue.
Yes. If expenses seem unusually low compared to revenue growth, maybe costs are being improperly capitalized.
Treating immediate costs as if they have future value.
Precisely. Marketing costs are another area. Generally, expense them immediately. But AOL tried to capitalize a huge chunk of their marketing and member acquisition costs, arguing for a narrow exception.
The fly.
The SEC ultimately disagreed, said AOL's unstable business didn't allow reliable forecasts of future benefits. Even when rules might allow capitalization, like Lucent did with internal software costs, investors should see the profit boost is often just a one-time thing.
So be skeptical of big changes in capitalization policies, especially for costs usually expensed.
Right. And even if they capitalize costs, they eventually have to expense them through amortization or depreciation. Yes. What gains happen there? They can stretch it out, amortize over an excessively long period. Unrealistically long. AOL, after capitalizing marketing costs, then doubled the amortization period from 12 to 24 months.
Having the annual expense.
Pretty much. Significantly inflated reported profits, obscured huge underlying losses. Analyzing the cash flow statement often reveals this. AOL's net income might look okay, but operating cash flow was hugely negative.
The cash flow statement tells a different story.
Often does. It showed the reported profits weren't real cash. For you, compare depreciation amortization to capital spending and asset types. Unusually low depreciation could mean overly slow amortization.
So income statement looks good, cash flow statement reveals the truth.
Can do. Another tactic, failing to write down assets that have lost value. Accounting rules say you have to assess assets and write them down if impaired.
Applies to what kind of assets?
Various types, bad debts, investments, inventory, New Century Financial, the subprime lender that collapsed.
Yeah, I remember them.
They actually reduced their loan loss reserves even as delinquencies were soaring. Defied economic logic, massively overstated earnings. Similarly, companies might avoid writing down impaired investments in market downturns to prop up profits.
Pretending losing investments are still winners.
Basically. For you, be alert if reported asset values seem out of whack with market conditions or industry trends. Failure to recognize impairments artificially inflates earnings.
Okay, what else?
Misuse of vendor credits. Syntax Brilliant got huge credits from a vendor, just bookkeeping entries, no cash.
But it boosted profit.
Inflated gross profit, yes, but resulted in severely negative cash flow. Big disconnect between reported income and actual cash. As an investor, always look for healthy alignment between profit and operating cash flow. Big gaps can signal unsustainable income boosts.
Following the cash seems key here. Any other ways to inflate income short term?
Failing to accrue expenses for likely losses, like lawsuits or tax disputes, delaying recognizing future expenses boosts current earnings.
Kicking the expense can down the road.
Or downplaying off-balance sheet purchase commitments that could hurt later. Changes in self-insurance assumptions. Rent-a-Sender did this with workers' comp accruals, or pension estimates Navistar changed life expectancy assumptions.
Little tweaks that add up.
Can provide a one-time, non-recurring boost. And sometimes it's simple, reversing accrued expenses. Fitbit reversed year-end bonus accruals when they knew they wouldn't hit targets. Makes cost management look better, but it's just a one-off adjustment.
So you need to watch changes in reserves, accruals, assumptions, and ask why.
Exactly. Understand the rationale.
It feels like it all boils down to finding levers in the accounting rules to make numbers look better short term, even if it's not the economic reality. Okay, we've hit boosting current income. What about the opposite? Shifting current income to later. Why do that?
A few reasons. Maybe they had a blowout quarter, beat expectations by a mile. They might defer some good news to a future period where they might need a boost.
Smoothing things out?
Right. Smooth out the earnings trend, present an image of steady, consistent growth. Investors like that.
So creating a cookie jar of earnings to dip into later. How's it done?
One common way is creating reserves. Overestimate potential liabilities, set up a bigger than needed reserve. Later, when you want to boost earnings, just release some of that excess reserve back into income.
Manages reported earnings over time. Seems hard for outsiders to spot.
It certainly can be. Another tactic, maybe less common now with rule changes, involved improperly accounting for derivatives to smooth income volatility.
At acquisitions.
Creating reserves during an acquisition, then releasing them later to enhance earnings, and then there's just delaying recording current sales until the next period.
Why would managers do that?
Maybe they already hit their bonus targets for this period, push some sales into the next quarter to ensure good bonuses then too. Platinum Technologies' revenue dropped sharply just before Computer Associates bought them. Raised Suspicions revenue was held back.
So look for weird fluctuations in sales or reserves, especially around acquisitions or volatile periods.
Definitely. It's not just managing current perception, but influencing future expectations too.
Okay, now the other side. Shifting future expenses into the current period. Why make today look worse?
It's like cleaning the slate. If you're having a bad quarter or year anyway, might as well recognize future expenses now. Makes future periods look better by comparison. Take a big hit all at once.
The big bath approach. How?
Improperly writing off plant and equipment considered impaired. Aggressively accelerate depreciation. Take a huge impairment charge even if assets are still usable. Reduces current earnings, yes.
But lowers future depreciation expense.
Exactly. Makes future periods seem more profitable. Sunbeam under Chainsaw Al Dunlap. Notorious for this aggressive accounting. Cut costs, massive write-offs. Stock might jump initially, but doesn't always mean the underlying business improved.
What else?
Creating a restructuring reserve that's bigger than needed. Announce layoffs. Take a charge for more employees than you actually plan to terminate.
And release the excess later.
Release the excess reserve into income in future periods, artificially boosting earnings. For you, be wary of unusually large restructuring charges or asset write-downs, especially if followed by periods of unexpectedly low expenses.
Taking a bigger bath now to look cleaner later?
Precisely. Now, we spent a lot of time on earnings manipulation. That's part 2 of the book. But part 3 shifts focus to another critical area, the statement of cash flows.
Right, the statement of cash flows. Lots of investors think this is more reliable than earnings, harder to manipulate. Is that true?
Sadly, that perception is often wishful thinking. The statement of cash flows is definitely not immune to manipulation.
Really? Cash is cash, isn't it?
In some ways, manipulating cash flow can be just as straightforward, maybe even easier than manipulating earnings, with investors focusing more on cash flow from operations or CFFO.
Companies get creative.
Increasingly creative in finding ways to inflate it. So for you, it's crucial not to just rely on the cash flow numbers without understanding how they were generated.
Okay, so what are the main types of cash flow shenanigans?
They focus mainly on 3 categories. First, inflating CFFO by shifting financing cash inflows to the operating section.
So making borrowed money look like operating cash?
Exactly. Misclassifying cash from borrowing as if it came from core operations.
How do they blur that line? Isn't it usually obvious if it's a loan versus customer payments?
You'd think so. But one example is recording normal bank borrowing as bogus CFFO. Delphi Corporation, after spinning off from GM, needed to show strong results.
What did they do?
Engaged in several schemes, including treating a bank loan as a sale of inventory, directly boosted their reported CFFO.
Wow.
So for you, be cautious with sudden, unexplained surges in operating cash flow, especially if it doesn't seem linked to underlying business improvements.
It's mischaracterizing where the cash came from.
Exactly. And the book strongly warns against relying too much on pro forma CFFO metrics, those non-standard versions companies define themselves.
Like adjusted CFFO.
Right. Delphi featured its own operating cash flow figure in earnings releases. It was wildly different and better than their GAAP CFFO, conveniently excluded certain big cash outflows, painted a much rosier picture. For you, always prioritize the GAAP statement of cash flows. Be highly skeptical of non-GAAP cash flow metrics without a clear, justifiable reconciliation.
Using similar terms for different calculations, very misleading. What's the second cash flow shenanigan category?
Boosting CFFO by selling receivables before the collection date. Selling accounts receivable or factoring is legitimate. You get cash now for outstanding invoices from a bank minus a fee.
Accelerates cash from sales. Makes sense.
And normally that cash inflow is correctly classified as operating cash flow.
So where's the shenanigan?
When companies do sham sales or don't genuinely transfer the risk of collection, Peregrine Systems, again, did fraudulent sales of receivables as part of their cover-up.
How did that work?
Transferred receivables to a bank for cash, but kept responsibility for collection losses, which, given their fake revenue, were huge. It artificially inflated. CFFO looked like cash from operations, but was really debt disguised as a sale.
The Watergate of shenanigans, the book called it.
Yeah, highlights how far they went to hide inflated receivables. For you, watch for big increases in receivables sold, especially with weak underlying sales. And read the risk factor disclosures. Clues might be there.
Got cash up front, but still on the hook if customers, who might not be real, didn't pay. Deceptive double whammy. Okay, third cash flow category.
This involves techniques to move cash outflows from the operating section to other sections, usually investing. Goal: make CFFO look healthier.
Shifting expenses out of operations. How? Isn't it clear if cash out is for operations versus long-term assets?
Again, principles are clear, but there's room for interpretation and misclassification. One method involves boomerang transactions. Global Crossing did this.
Oh.
Sold future network capacity for big, upfront cash-boosted CFFO, but simultaneously made huge capital expenditure commitments to the same customers, basically buying back the capacity.
Circular money movement again.
Exactly. Net economic benefit. Questionable. But it inflated reported CFFO. For you, be wary of complex, simultaneous deals with the same counterparty, causing big, unusual cash flows.
Okay. What else shifts outflows?
Improperly capitalizing operating costs like WorldCom's line costs we talked about, that also boosts CFFO.
How does capitalizing impact cash flow sections?
When you capitalize an expense, the cash outflow gets classified as investing, buying an asset, instead of operating an expense. Directly increases reported CFFO.
So what's the ratio of capital spending to revenue?
Yes. An unusually high ratio might mean operating expenses are being hidden as capital investments, another, less common trait. Recording inventory purchases as investing outflow instead of operating removes a normal operating outflow from CFFO.
Makes CFFO look stronger.
And finally, shifting operating outflows off the statement entirely. Like funding pensions with non-cash assets. Diageo used aged whiskey, IBM used treasury bonds. It's legitimate, but doesn't hit reported cash flow like a cash contribution would.
So maybe okay by the rules, but need to grasp the economics?
Right. Understand the substance and impact on financial flexibility.
Key seems to be scrutinizing how cash inflows and outflows are categorized, skeptical of weird shifts. Now, part 4. Key metric shenanigans. Why look beyond the main statements at these metrics?
Because companies often highlight specific metrics they want you to focus on. And these can be misleading if not analyzed carefully in full context.
So don't just take their highlighted numbers.
Right. Successful investing needs rigorous analysis of a broad range of metrics, not just headlines. Understanding how key metrics can be manipulated is essential to get the true picture.
So it's about understanding which metrics matter and how they can be twisted.
Precisely. The book identifies 2 main types here. First, showcasing misleading metrics that overstate performance. Using non-GAAP measures or unique industry metrics that, intentionally or not, create a better impression than standard GAAP figures would.
What kinds of revenue surrogates should we watch out for?
Companies use unique metrics. Subscriber counts for cable, load factor for airlines, paid clicks for web portals, RevPAR for hotels.
Useful sometimes.
Can be. But you must understand exactly how they're calculated and if they truly reflect sales and profit. Same-store sales, SSS for retailers, can be manipulated by changing the definition of same-store or the comparison base.
Bookings and backlog.
Often used by tech firms. Also non-GAAP, lacks standard definitions, gives companies lots of discretion. For you, always dig into the exact definition and calculation of any non-standard metric. Track consistency over time.
Scrutinize definitions, calculations, consistency. Got it. What about earnings surrogates? EBITDA comes up a lot.
Yes, EBITDA and its variations can be useful sometimes, but it's not a substitute for net income or cash flow. It excludes real costs like interest, taxes, depreciation.
And adjusted EBITDA.
Companies often remove more expenses they call one-time or non-recurring. can create a highly misleading picture of true profitability. Global Crossing did this.
So watch out for too many adjustments.
Definitely. Terms like cash earnings or other non-GAAP cash flow metrics can also be confusing, might exclude important outflows. Delphi's operating cash flow we mentioned, prime example.
Little resemblance to GAAP CFFO.
Exactly. Even metrics for dividends like Lin Energy's distributable cash flow can be dodgy if they exclude necessary maintenance capital spending.
So always compare non-GAAP to GAAP, understand what's included, and maybe more importantly, excluded.
Absolutely critical. Don't take company-defined metrics at face value. Do your own homework.
Okay. Second key metric shenanigan category.
Distorting balance sheet metrics to avoid showing deterioration. Manipulating or presenting balance sheet figures and ratios to hide underlying weaknesses or negative trends.
How? The balance sheet's just a snapshot, right? Assets, liabilities, equity.
It is, but presentation matters. Selling receivables, which boosts CFFO, also lowers days sales outstanding DSO, makes it look like you're collecting faster, even if it's just from selling them off.
Not better collections, just factoring.
Right. Reclassifying accounts receivable as notes receivable. Symbol Technologies allegedly did this to mask increases. Changing how you calculate a ratio, like DSO Telebs Inc., apparently did that, can also hide deterioration.
What about inventory?
Tween Brands created an unusual in-store inventory metric, excluded a big chunk of their total inventory, made growth look much lower.
Clever, but deceptive.
And combining reserve accounts. New Century Financial grouped their crucial loan loss reserve with another, less critical one, obscured potential deterioration in the key reserve.
So for investors,
Track trends in key balance sheet ratios. Be wary of changing calculation methods. Look for weird classifications or combinations that might hide bad news.
it's often presentation and definitions masking problems you'd see if you just calculated ratios consistently yourself. Now, the newest section, Part 5. Acquisition Accounting Shenanigans. Why is M&A so ripe for manipulation?
Because mergers are inherently complex. Lots of accounting judgment, estimation. They can also be a convenient smokescreen.
To hide existing problems.
Yeah, problems in either company. Or even hide other ongoing accounting games, like with Olympus Core. The whole process of integration, allocating purchase price, can be used to artificially inflate future revenue, earnings, overstate cash flow, manipulate metrics in ways not immediately obvious.
So extra scrutiny needed when companies are buying others.
Essential. Pay even closer attention to their accounting and reported results.
It's about burying bad news or creating fake positives within the complexity and opacity of a merger.
Exactly. One common trick. Artificially boosting revenue and earnings after the deal closes.
How?
A company growing mainly by acquisition might spend way less on its own organic R&D compared to internal growers. Lower R&D means higher reported profit short-term after the deal.
Even if long-term innovation suffers.
Right. Or they create dubious new revenue streams post-closing, like the hypothetical buyer Ben and seller Sam's licensing fee, questionable economics, or FPA Medical's rebate deal with Foundation Health after merging seem designed just to inflate revenue.
So be skeptical of sudden profit jumps or new revenue right after a deal. Understand the drivers.
Yes. Are they real or manufactured? These often wouldn't exist if the company stayed separate.
What about manipulating cash flow during acquisitions?
Inflating reported cash flow is another key area. Acquisitive companies often show impressive CFFO just due to accounting rules.
How does that work?
When you buy a company with positive net working capital, current assets minus current liabilities, liquidating that working capital post-acquisition, the cash inflow is classified as operating cash flow.
But the cash used to buy the business, including that working capital.
That's classified as an investing outflow. This accounting quirk can create an artificial, often unsustainable boost to the acquirer's CFFO.
So the cash flow statement looks better than the underlying cash generation.
Can do. Plus, companies might try treating normal operating costs as acquisition expenses to overstate CFFO. Tyco did this with dealer payments. Or structure the sale creatively to shift cash inflows from investing into operating for the acquirer.
So when analyzing CFFO post-acquisition, dissect it carefully. Watch for boosts disproportionate to profit.
Absolutely. Be wary.
And the third acquisition shenanigan, manipulating metrics.
Yes, manipulating key metrics. It's often hard to separate organic revenue growth from the acquired company's contribution. Management might misleadingly blend them.
Making organic growth look better than it is.
Could be. Similarly, immediately including acquired stores in same-store sales calcs, Starbucks did this, sometimes distorts the true performance of the original business.
What else?
A big gap between GAAP earnings and non-GAAP adjusted earnings, especially in serial acquirers like Valiant Pharmaceuticals, is a red flag. Adjustments often relate to acquisition costs.
Hiding the real cost of acquiring growth.
Can look like that. Even post-acquisition restatements, like Hertz had after buying Advantage Rent-A-Car, impact perception of the deal's success and number reliability. And non-cash deals before a merger, like BioVale did before merging with Valiant, can sometimes inflate CFFO temporarily pre-merger.
Well, it comes up again.
The book touches on their complex accounting issues in buying Medicis, Bausch & Lomb, and even failed hostile bids for Cephalon, Allerg, and Salix, just illustrates the many opportunities for manipulation.
So for acquisitive companies, be extra diligent on growth drivers, profitability, and super skeptical of non-GAAP metrics far from GAAP results.
Precisely. Acquisitions demand much deeper scrutiny to see the true picture.
It really underscores that. Now, the book finishes with a crucial chapter, the forensic mindset. What's the core message there for listeners?
The fundamental idea is that spotting shenanigans isn't just about memorizing rules or techniques. It requires cultivating a specific mindset, a forensic mindset.
What does that involve?
It's characterized by healthy skepticism, strong curiosity, intellectual humility, understanding human behavior and motivations, and a commitment to fair play and transparency. For you, developing this thinking is a huge advantage.
So it's more than just crunching numbers.
Absolutely. Skepticism is your starting point. Always ask why, and maybe more importantly, why now? When you see changes in accounting, policies, trends, metrics.
Don't just accept the company line.
Never. Look beyond the surface narrative. Could underlying business problems be hidden? Consider the corporate culture. Does it foster aggressive accounting? Never blindly accept the company's own framework for measuring profit.
What else is part of this mindset?
Understand executive compensation incentives. How might they influence decisions? Even mundane things matter, like where info is located in disclosures. Remember, every detail could be significant. Look for patterns of behavior or weird coincidences, often reliable signals.
So adopting this forensic mindset means being a more critical reader of financial info. Always looking for inconsistencies, things that don't add up.
Exactly. Become more discerning.
Sounds like developing a keen sense for inconsistency and asking tough questions are essential skills for any investor wanting the real story.
They truly are. The authors argue this mindset provides a real competitive advantage. Being skeptical, watching subtle changes, digging deeper, you can spot problems others miss.
This has been incredibly eye-opening, a bit unsettling sometimes, but really valuable for evaluating company reports.
That's the goal. Understanding these techniques, and especially adopting that forensic mindset, it's a crucial layer of protection for every investor.
So apply these principles, stay alert for those changes and inconsistencies.
We strongly encourage you to do that in your own analysis.
And while we covered a lot today, the book obviously goes into much more detail, right? More case studies.
Oh, absolutely. Financial Shenanigans is comprehensive, invaluable for anyone wanting to be a more informed, discerning investor.
Any final thought to leave us with?
Just that, ultimately, while companies might try to hide the truth with accounting games, a company's real economic health, it eventually comes out. Understanding these shenanigans helps you see that truth sooner, potentially saving you from big losses.
A sobering but vital point. Thank you so much for guiding us through this deep dive.
My pleasure.